5-star copies all. Go ahead. Message to observer. Alpha 3 rounds. AT delay in effect. 3 guns. Bravo 2 rounds. 2 guns. Smoke on effect.
Hey, this is Andrew from the Options Millionaire community. Thanks for watching another video from the Options Trading How-To series, where I'll be discussing everything from the most beginner of options trading strategies to the most advanced and everything in between. My goal is to equip everybody watching these videos with as many tools as possible to become safe, profitable, and consistent in the long term. So I'm excited to make this video. It's a video that I've been asked to make about 1,000 times over the past few months, especially as I've talked more and more about it. It's generated more and more interest in the server, and more people want to know about it. And for good reason. It's a fantastic strategy to develop consistent income over the course of the long term, which is exactly why we're here. So this video is how to trade credit spreads, or more importantly, how to generate income trading credit spreads. So are you just a normal scalper or day trader? Do you usually only just trade long calls or long puts? Have you ever found yourself buying a call in a situation just like this just to have this happen to you? Or have you ever bought a put right here just to have this happen to you? This is the risk you face all the time when you're only trading long calls, long puts, scalping long positions. Yes, you can be very accurate, you can have a very high win rate, but there is an inherent risk in the market of the unexpected nature of price action. Buying a put right before the price goes up, buying a call right before the price goes down, etc., etc. Sometimes you just don't want to take that risk. Sometimes the market is just far too choppy to be able to define where the price is going, so you just don't trade at all. Well, I'm here to tell you there's an additional tool you can add to your belt to trade in addition to long calls, long puts, to start generating some consistent income when the market is a little unpredictable, and those are credit spreads. So what is a credit spread? A credit spread is one sells or writes a high premium option and at the same time buys a lower premium option. So when you sell an option, you receive that premium. When you buy an option, you pay that premium. The difference that you receive is called a premium credit. It's credited into your account when the position is opened. And that is also your max profit for the strategy. For example, current price of SPX is 4,538. If you were to sell a 0 DTE 4650 call for a premium of $10 and then buy a 4700 call at $3, you would get a net credit of $7. That's 10 minus 3. Your max profit would be $700. Now, how does this actually work? I'm sure this is a little confusing to some who have never seen this before, because obviously I'm buying and selling calls that are above the current strike price, and yet I'm still making money. Well, how does that work? Well, selling calls above the current strike price is actually a bearish position. It is the opposite of buying a call. When you buy a call here, you make money when the price increases, thus increasing your premiums and increasing your profits. However, when you write or sell a call, you want that position to stay at least below your strike price or out of the money, because you are collecting premiums. You're not trying to gain an increase in premium by buying a call. You have sold or written a call, so you want to gain that premium. The more this price stays outside of your strike price, that position will decay down to 0, thus giving you 100% of that premium collected, or 100% gain. Now, that makes sense, right? Well, why did I buy a $4,700 call in addition to my selling 4650 calls? So there are two reasons why I bought this $4,700 call in addition to selling this 4650 call. The first one is that the margin requirement for credit spreads is substantially lower than uncovered options. If I were just to sell this uncovered 4650 call, the margin requirement would be incredible on this. Especially on SPX, you could be, and depending on the number of contracts you're going to be selling, you could be talking over 6 figures, well into the 6 figures. However, when you bring in buying a call, you get that net reduction in margin requirement. What do I mean by that? Well, in order to calculate the margin requirement for this type of play, you would take the strike of the 4650 leg and then the strike of the 4700, which is 4650, 4700. The difference is $50. You multiply that times 100 and you get a $5,000 margin requirement, substantially less than the 6-figure plus requirement for just selling a naked 4650 uncovered position. The second reason is to greatly minimize your potential loss. If I were just to sell this 4650 call without buying the $4,700 call, and this position were to continue to climb and climb and climb, my losses are potentially limitless, meaning as high as this price grows, the premium of my call that I purchased continues to grow and grow and grow, increasing my potential losses to hundreds, if not thousands of percent losses until you actually cut the position. So buying the call actually gives me a max loss potential. Now this to me is the main benefit to doing spreads as opposed to just selling or writing a call or a put alone. It's just that you have a max loss that you can start to plan around in the event of a worst case scenario. Okay, so how do you calculate max loss? Well, you take the difference between the strikes minus the credit you received, and you multiply that times 100 contracts, and that gets you your max loss. In this case, you would take 4,700 minus 4,650, and that gets you 50. You subtract the $7 credit we received for opening the position, and you multiply that times 100. That gets you $4,300 loss. That's your max loss, $4,300. Now you hit max loss once the price of the underlying, in this case SPX, goes above your long call strike price, which in this case is 4,700. So if SPX were to climb and pop through 4,700, anything up here is max loss of $4,300. Okay, great. Now that we've calculated max loss, let's calculate when do we actually start making money. Well, we've already said if the price goes above 4,700, we will hit max loss. Anything above here will hit max loss, which is $4,300. Anything below 4,650, if the price closes outside the money of this call, we collect 100% of our premium, which we figured out to be $700. Well, in order to calculate your break-even price, what you do is you take your short call leg strike price of $4,650 and you subtract your credit, which in our case is $7, the 10 minus 3. And that gets you $4,657. So what does this mean? Let's expand this a little bit. If the price that finishes below the 4,650, we get 100%. As the price starts to climb in past 4,650 and goes up, we start losing that profit. Now it's down to $500 profit. Now it's down to $400, down to $300, now it's down to $200. And then once we hit that 4,657, we break even. And then anything above here, we start losing money. And now the losses start increasing. $500 loss, $1,000 loss, $2,000 loss, $3,000 loss. And then once we climb above, we hit max loss of $4,350 and it doesn't get any higher. Okay, so let's look at an example of a put spread. So the current price of SPX is $4,538. On this example, I wrote or sold 4,450 puts and then bought a 4,400 put. Same thing as last time, except instead of doing calls, I'm doing puts below. Now, if the price stays above my current short put strike, I make 100% of my profit. As long as the price stays and closes or expires outside the money up here, I get 100% of my profit. Now, if the price falls and goes below my long put price, I get max loss. So this is the same concept as before, except instead of calls, which is a bearish position, I am now doing these puts here, which is a bullish position. I think this price is going to at least stay above 4,450, if not increase. Ultimately, I want this price to start to separate away from here to give me some comfort on expiring outside the money. I want this price to expire outside the money on my puts. All right, so let's go over a real world example. This is from Friday, December 3rd, 2021. And I traded 4 spreads on this day. I knew I was going to be aggressive because I knew the market was very charged and I wanted to take advantage of the up or down, and I didn't know which one at the time, up or down movement of the market. So I waited for the market to break right at the open and we came down. And once I found a good, strong direction of sellers, the whole market sentiment had gone negative and the market was deteriorating. So I elected to open the first call credit spread up here with a short leg of 46.50 and a long leg of 46.70. What that means is I sold that 46.50 call and I bought the 46.70 call at the same time. And then I watched as the market began to deteriorate again even more. Down here, I elected to open a second call credit spread right here. Now this one had the same long position strike. However, I moved the short leg down. This is a second position, additional position. So I went with a 4,600 strike. And all that says is now I think holding these 2 positions that the price is going to stay below 46.50. And now the second leg says I think it's not going to go above 4,600 now. So I'm holding both these positions, hoping that this position closes under this position. Now, these are 0DD positions, so I only need to hold them for the one single day and hold them till expiration. And the price began to decay down and down and down. And actually, going on to the third play I took was actually a put credit spread. So we came on down, the price fell, and once we bottomed out right here, I elected to take this put credit spread right here. Now I opened the short put at 44.50 and the long, I bought the long put at 4,400. Now, this is the same concept as here, except once again, like we explained, this is a put credit spread, so I think the price is going to stay above this position. Now, as for the savvy investors, y'all know that I just backdoor legged myself into an iron condor. We won't talk about iron condors today. I'll do actually another video about iron condors, but that's all this is. I essentially legged into an iron condor. So now I'm holding 2 call credit spreads, and I opened a put credit spread once the price fell and dropped right here. Now, why did I wait all this time for to open the put credit spread if I think it was going to go above 44.50 instead of waiting and buying it up here? Well, I wanted the price to drop and drop and drop and get the nice thick premiums on some puts. And honestly, I didn't expect to open a put credit spread down here, but once I saw the price start to reversing, the market start to bottoming out here, I knew 4,500 was going to be very strong support. I elected to go ahead and take this one to squeeze out some additional profits. Normally, and if you see, it was already 2 o'clock Central, 3 o'clock Eastern time, very late in the day for a 0 DTE. Normally, I would never open a credit spread this late in the day on a 0 DTE because the premiums are usually pennies. The risk is definitely not worth the reward. However, on this day, IV was incredibly high. VIX was over 34. Premiums were still very juicy. I was still able to get over $2 for this particular position, which was an incredible return for a 0 DTE with about an hour remaining in the market. So I'd like to take this put credit spread and started to climb back up. And then once the position started to bounce a little bit, I figured we weren't going to get back over 44.50. So I elected to open a 4th or a 3rd credit spread for a 4th overall position right here. Now this was the short call leg at 45.50 and the long call leg at 45.75. And you can see it actually did get a little close. I started sweating this one a little bit as the day went on because we had that late rally right up into close. But eventually, the position closed outside the money on all 4 of my positions. This one, this one, this one, and this one up here. All 4 positions closed outside the money. So I was able to collect max profit on all of those positions. Actually, this position I closed at 40% profit because I actually had to get on the road to drive and I wasn't able to manage this last position. So I closed this one to 40%, and this one I let all 3 of these go to 100% max profit for a fantastic day. All 4 positions yielded fantastic money for that day. But you can kind of see a good way, a dynamic way on when to enter and exit different credit spreads, how to set yourself up for maximum success for minimal risk, or I should say minimized risk, as opposed to just long calls, long puts. So it seems too good to be true, right? All you have to do is pick strikes that are further enough outside the money and collect your 100% premium. Well, I thought the very same thing when I first started trading spreads, but there's a little more to it. Let's go over the pros and cons of trading spreads versus other positions. So pros, you have a defined risk. You know your max loss ahead of time. As long as you can manage against that, in a worst case scenario, you get a max loss and you know that ahead of time. The second pro is, which we kind of talked on there a second ago, is you have to be less right than you would be in just trading long calls, long puts. So for example, this little call right here, as long as the position stays below this line, I make money. So the position can do all this. It can go up and down, it could chop, it could rally, it could sell off, it can come all the way down here. As long as it stays below my short call position right here, I make money. So you have to be less right. AKA, you don't have to be as accurate as sniping a long call or long put entry point. Number 3, you're able to calculate profit ahead of time. You know exactly how much money you're going to make ahead of time. Number 4, far less margin requirements than selling naked options. If you write naked options, you're looking at a very, very large amount of margin requirement. However, when you do spreads or bring in the buying the put or buying the call into the equation, you start reducing that margin requirement a lot more. Number 5, and one of my most favorite things about these positions is they're set and forget to an extent. What do I mean by set and forget? When market conditions allow, or if their market conditions are not too volatile, or if you place your strikes further enough outside the money, you could pretty much set it and forget it. Set it, go walk away, go to the gym, go outside, enjoy your day, come back in an hour or 2. Set alerts on your trading view or on your broker account to make sure that if the price does start moving against you, you can run back to the computer and take a look. But I could set this position right here, walk away, do my thing. As long as I have my alerts set in place, I can my account will let me alert back into this and come back in here and start managing the position. A very, very attractive quality for a lot of different traders who do not want to sit in front of a computer all day and snipe scalping entries. So let's take a look at the cons. So you still can face substantial losses. Even when you're playing spreads and you know your max loss, they can still take a large loss, especially if you don't have them in that position, or if you do let it run to a max loss scenario, you still can face a significant loss. The second, limited profit. Yes, you are a little safer and they are set and forget. However, you're giving up some of the profit in order to buy that risk. You're buying back some of the risk. It's a safer position. Just like in all things in life, the less riskier, the less money you make. The more riskier, the more money you make. So because these are a little more safe, you do get a smaller amount of profit. A $700 credit on the position that we talked about earlier, as opposed to maybe, a couple of thousand, depending off your long call, long puts. Another con, assignment if the position closes in the money. Now, I will say this, there's a common misconception when you are selling options that you can only be assigned if the position goes in the money. That's just not true. You can be assigned at any time if you are writing positions. So definitely a big con, and I would probably say the most glaring one in this list is being assigned, the risk of being assigned on these positions that you're writing. However, one of the reasons I trade SPX, one of the many reasons I trade SPX and SPX only on spreads is that you cannot be assigned. SPX is cash settled, which means there's no assignment of shares on SPX. So once again, one of the many, many reasons that I trade SPX on spreads only is because of that reason. Number 4, higher commissions. You're buying 2 positions at once. You're buying a call and you're selling and you're writing a position. So you are doing double the amount of commissions on these plays when you're opening and closing. So they're a little higher commissions. For me, commissions, no big deal. They're only 50 cents per, no big deal, but it is definitely a con you want to consider when calculating your bottom line. Anyway, that's all I got for you. One of my favorite videos to make because I know a lot of people really, really want to learn about this stuff. So I hope you learned a little something along the way. It's definitely a beginner's guide. There's a lot more to spreads. There's a lot more strategies and utilizing spreads like iron condors, butterflies, etc. that we could talk about and we will talk about in the future, but it's a great starter video for how to learn for spreads. I hope you all enjoyed it. If you have any questions, concerns, hit me up anytime in the Discord. The link's down in the description if you want to join and be a part of that. Come over and join the Patreon, man. A small entry fee for a wealth of information, and we're growing every day, new ideas every day on how to expand the community to bring a better product for you. If you are new to the channel, hit that like and subscribe button. You get notifications for all my educational content, the how-to series coming out, as well as my Monday, Wednesday, Friday YouTube live streams. If you want to get a copy of all the books that I read, head over to my website, www.theoptionsmillionaire.com. I have a list of all of the resources there, as well as a couple of awesome investing related hoodies and shirts. Take a look there, tell me what you think. So until next time, y'all, always remember, the only thing separating you from financial greatness is the decision to be better. Y'all take it easy. I'm out.